In less than 12 hours, China activates a financial weapon that will reshape the global silver market forever. The clock is ticking. January 1st, 2026, midnight Beijing time. That's when China's Ministry of Commerce flips the switch on export licensing restrictions that give them control over 60% of the world's refined silver supply. While you were celebrating New Year's Eve, while Western markets were closed for the holiday, while the mainstream financial media was publishing their year-end recaps, China was preparing to weaponize the one metal the global economy cannot function without. Silver is sitting at $76 per ounce right now. That's what your screen shows. That's what Trading Economics reports. That's what CNBC is telling you is expensive after a historic rally. But that number is about to become meaningless, because in 12 hours, the rules change, the supply chain fractures, and the price discovery mechanism that's been suppressed for decades finally breaks. This is not speculation. This is not a rumor. This is verified policy from MarketWatch, Yahoo Finance, and multiple financial sources. China announced this weeks ago. They gave the world notice, and the world ignored it. The analysts dismissed it. The banks downplayed it. The media buried it under holiday news cycles. But here's what they're not telling you. Here's what the Western financial system is desperately trying to hide. Here's why $76 silver is not expensive. It's the last cheap price you'll ever see. China doesn't just mine silver. They refine it. They process it. They turn raw ore into the pure metal that goes into solar panels, electronics, electric vehicles, and industrial applications. 60 to 70% of all refined silver on Earth flows through Chinese facilities. And starting in 12 hours, every company that wants to export that silver needs a government-issued license, a license that requires 80-ton minimum capacity and $30 million in annual revenue, a license that the Chinese government can approve, delay, or deny at will. This is not a free market anymore. This is a controlled market. And the controller is a nation that's been stockpiling silver, building strategic reserves, and preparing for this exact moment while the West was distracted. But here's the detail that should terrify every investor who thought precious metals peaked. Here's the detail that makes Monday's crash from $84 to $73 look like a setup. Here's the detail that proves the $76 rally isn't a bubble, it's a bear trap. On Monday, December 29, silver crashed, 10% in one day. From $84 to $73, the CME group raised margin requirements. Speculators were forced to liquidate. The media screamed that the rally was over, that silver had topped out, that the smart money was exiting. Then Tuesday happened. Silver bounced from $73 back to $76. A 4% recovery in 24 hours. Stronger than anyone expected. Faster than the bears could cover. This is a textbook bear trap. A false breakdown designed to shake out weak hands before the real move begins. And the real move doesn't start until China's restrictions go live. In this investigation, I'm going to expose exactly what China just did. I'm going to walk you through the mechanics of export licensing, what it means for supply chains, what it means for industries that depend on silver, and what it means for the price. I am going to show you why Monday's crash wasn't the end of the rally. It was engineered capitulation designed to let smart money accumulate at $73 before the China news went mainstream. And I'm going to prove to you, using verified sources and supply-demand mathematics, why $76 silver is not the top. It's the floor, the baseline. The last price before the licensing system creates a supply crisis that sends silver to $100 and beyond. MarketWatch called it China's silver weapon. They're not exaggerating. When a nation that controls 60% of refined supply implements export controls, that's not a policy change. That's economic warfare. And the target is the Western financial system that's been shorting silver, suppressing prices, and pretending infinite paper contracts can exist without physical metal to back them. China is about to call that bluff. In 12 hours, the game changes, and the investors who understand what's happening will be positioned for the most explosive precious metals move since 2011. The screen says $76. China says that number is irrelevant. They're taking control of supply. And when supply gets weaponized, price becomes whatever the market will bear. This is the story of China's silver weapon, and it activates in 12 hours. Part 2, the policy that breaks the market. If you just watched Part 1, you now know that China is implementing silver export licensing in 12 hours. You know this is verified news from major sources, but now we have to understand the mechanics. What exactly did China announce? How does the licensing system work? And why does this seemingly bureaucratic policy change have the power to send silver from $76 to triple digits? In Part 2, I'm going to break down the policy, expose the supply chain implications, and show you why this is the most significant precious metals development since Nixon closed the gold window in 1971. Let's start with the official announcement. According to MarketWatch, Yahoo Finance, and multiple verified sources, China's Ministry of Commerce issued new regulations requiring government-issued licenses for silver exports starting January 1st, 2026. This isn't a rumor. This is published policy. Here's how it works. Any company that wants to export refined silver from China must now obtain a license. To qualify for that license, the company must meet two criteria. First, they must have annual refining capacity of at least 80 metric tons. That's roughly 2.5 million ounces. Second, they must have annual revenue of at least $30 million. These thresholds sound reasonable until you realize what they eliminate. Small and mid-sized refiners are instantly shut out. Independent exporters are blocked. The only entities that can get licenses are large, state-owned enterprises or companies with close government ties. This consolidates control. But here's the real weapon. Even if a company meets the thresholds, the license is not automatic. It's discretionary. The Chinese government can approve it, delay it, or deny it based on undefined strategic considerations. This gives China the ability to choke supply to specific countries, specific industries, or specific buyers without officially announcing a ban. If China wants to punish the US for tariffs, they delay licenses for exports to American companies. If China wants to pressure the EU on trade policy, they slow approvals for European buyers. If China wants to stockpile for their own industrial needs, they simply issue fewer licenses. The policy is the weapon. The licensing is the trigger. Now let's talk about why this matters so much. China doesn't just refine a little silver. According to industry analysis from AI Invest and multiple sources, China processes 60 to 70% of the world's refined silver. That's not an estimate. That's the reality of global supply chains built over 30 years. Most silver mining happens in Mexico, Peru, Australia, and the US. But most of that ore gets shipped to China for refining because Chinese facilities are cheaper, faster, and more efficient. Western countries outsourced refining capacity decades ago. They bet on globalization. They bet on free trade. They bet that supply chains would always be open. That bet just failed. Starting in 12 hours, China controls the choke point. They control the flow of refined silver to the world, and they can throttle that flow whenever strategic interests demand it. Let's walk through what this means for different players in the market. First, industrial users. Companies like First Solar, Tesla, Samsung. They need refined silver for solar panels, electric vehicles, and electronics. If their Chinese suppliers can't get export licenses, or if licenses are delayed, these companies face production shutdowns. They can't just switch to non-Chinese refiners overnight. There isn't enough spare capacity. Western refining infrastructure was dismantled. So what do? They panic buy. They lock in supply contracts at elevated prices. They pay premiums. They hoard inventory. This removes millions of ounces from the market, and it pushes prices higher. Second, investors. People buying coins and bars. The mints that produce retail silver, the US Mint, the Royal Canadian Mint, they source refined silver from global wholesalers. If Chinese exports slow, wholesaler inventory drops. Mints go on allocation. Dealers raise premiums. You see sold-out banners on websites. The physical market detaches from the paper price. Third, the banks, the shorts. The entities that sold paper silver contracts they can't deliver. They're betting they can roll positions forever, settling in cash, never actually delivering metal. But if industrial users start demanding physical delivery because they can't source from China, the shorts are trapped. They have to buy to cover. And in a supply-constrained market, buying to cover doesn't just move the price, it gaps it. China's licensing system doesn't need to be a full ban to break the market. It just needs to create uncertainty, delay, friction. That's enough to trigger a supply crisis in a market that is already running a 5-year structural deficit. According to the Silver Institute and multiple industry reports, the silver market has been in deficit for 5 consecutive years. Demand exceeds supply. The gap has been filled by drawing down above ground inventories, but those inventories are nearly depleted. COMEX registered vaults are at multi-year lows. LBMA stocks are tight. There's no buffer left. China's policy is the catalyst that exposes the deficit. It's the match that lights the fuse. And the explosion doesn't happen slowly. It happens violently. Here's the historical precedent. In 2010, China restricted rare earth exports. They implemented licensing and quotas. Prices for neodymium, dysprosium, and other critical materials went up 500% in 12 months. The world panicked. Industries scrambled. The US and EU filed WTO complaints. But by the time the complaints were resolved, China had already reshaped the market. Silver is not a rare earth. But the dynamics are similar. China controls refining. The world depends on it. And when dependency becomes weaponized, price becomes irrelevant. You pay what the supplier demands, or you shut down your factory. This is why Monday's crash to $73 was a gift. The CME margin hike forced weak speculators out. It created a flush. But the smart money, the industrial buyers, the sovereign entities, they bought the dip. They know what's coming. They know that in 12 hours, the supply equation changes permanently. The $76 price you're seeing right now is the market pricing in partial impact, a licensing system that slows exports but doesn't stop them. But markets are slow. They underestimate. They assume China will be reasonable. They assume the policy is symbolic. China is not symbolic. They're strategic. And their strategy is to control the resources that power the future economy. Silver is one of those resources, and they just took control. In part 3, I'm going to show you why $76 is not the ceiling. I'm going to walk through the supply-demand math that leads to $100 silver and beyond. And I'm going to explain why this isn't a short-term spike. This is a structural repricing. The China weapon doesn't fire once. It stays loaded. And that changes everything. Part 3, the math of $100 silver. If you've been with me through parts 1 and 2, you now understand that China's export licensing system activates in 12 hours. You understand the mechanics of the policy and why it gives China control over 60% of refined silver supply. But now we have to run the numbers. What does reduced Chinese export capacity do to global supply? What does panic buying from industries do to demand? And where does the price go when an already tight market gets hit with a supply shock? In part 3, I'm going to show you the math that leads to $100 silver, and why that's not the peak, it's just the next resistance level. Let's start with current supply and demand. According to the Silver Institute and industry data, global refined silver production is roughly 1 billion ounces per year. That's mine supply plus recycling. Demand is roughly 1.05 billion ounces. That's a 50 million ounce annual deficit. For 5 years straight, we've been drawing down inventories to fill the gap. Now China implements export licensing. Let's be conservative. Let's assume the licensing system reduces Chinese exports by just 20%. China refines roughly 600 million ounces per year, 60% of global refined supply. 20% of that is 120 million ounces. So immediately, the market loses 120 million ounces of annual supply. The deficit goes from 50 million ounces to 170 million ounces. That's a tripling of the shortage in one policy change, but it gets worse. Because reduced supply doesn't just create a deficit, it creates panic. Industrial users see the writing on the wall. They know China controls the choke point. They know licenses can be delayed or denied. So they shift from just-in-time inventory to strategic stockpiling. Now, let's say solar companies, EV manufacturers, and electronics firms decide to hold an extra 6 months of inventory instead of 1 month. That's not unreasonable, given the geopolitical risk. 6 months of industrial demand is roughly 300 million ounces. That 300 million ounces gets pulled from the market and locked in warehouses. Add that to the 170 million ounce deficit. You're now looking at 470 million ounces of demand that cannot be met by current supply. That's nearly half of annual global production. What happens to price when demand exceeds supply by 47%? It doesn't go up 10%. It doesn't go up 20%. It gaps. It explodes. Because the marginal buyer, the last buyer who needs the metal, will pay whatever it takes. History gives us the template. In 2011, silver went from $18 in July to $50 in April. That's a 178% move in 9 months. The catalyst? Investment demand surged. ETFs saw inflows. Retail buyers stacked coins. But there was no supply crisis. The vaults were full. Refiners were producing. This time is different. This time we have a 5-year deficit. We have depleted inventories. We have industrial users competing with investors. And we have China weaponizing supply. The move won't be 178%. It will be larger. Let's do the math conservatively. Silver is at $76. A 178% move from here would be $211. But let's not go there yet. Let's just target $100. That's a 32% move from current levels. Is that realistic? Absolutely. If the deficit widens to 470 million ounces, as I outlined, the market needs to destroy demand or attract new supply. To destroy demand, price has to rise enough that marginal uses become uneconomical. To attract a new supply, price has to rise enough that new mines become profitable. Both of those outcomes require silver above $100. At $100 per ounce, some industrial applications get substituted. Some electronics use copper instead of silver. Some solar panels use alternative materials. Demand destruction begins. At $100, new mining projects in Mexico, Peru, and Canada become economically viable. Supply response begins. But that takes time. Demand destruction doesn't happen overnight. And new mines take 5 to 10 years to come online. So the $100 level is not a ceiling. It's a plateau, a temporary equilibrium before the next leg up. Now let's add the speculative element. When silver breaks $80, when it takes out the 2011 high of $50 decisively, when mainstream media starts covering the China supply crisis, retail investors flood in. They're not buying to hedge inflation. They're buying because the chart looks like a rocket ship. This is FOMO buying. And FOMO buying in a supply-constrained market creates vertical moves. Look at what happened Monday to Tuesday. Silver crashed from $84 to $73. Then it bounced to $76. That's a $3 move in one day, 4%. In a market that's supposedly crashing, that recovery is absurdly strong. Why? Because buyers stepped in. They saw $73 as a gift. They knew China's policy was coming. They accumulated. Those buyers are still holding. They're not selling at $76. They're not selling at $80. They're holding for $100, $120, $150, because they understand that this isn't a trade. This is a structural shift. China's export licensing doesn't expire. It's permanent policy. That means the supply constraint is permanent. The market has to reprice silver not as a freely traded commodity, but as a strategically controlled resource. And strategically controlled resources trade at premiums. Compare this to oil. When OPEC cuts production, oil doesn't just tick up 5%. It spikes 20%, 30%. The same will happen with silver. When the market realizes China is OPEC for silver, the repricing is violent. There's also the currency angle. Silver is priced in dollars. But China's policy is part of a broader de-dollarization strategy. If China starts demanding payment for silver exports in yuan instead of dollars, if they bypass the Western pricing system entirely, the dollar price becomes disconnected from the physical market. You might see COMEX silver at $75, while physical metal in Asia trades at $110. The premium blows out. The Western exchanges lose credibility. And the real price, the price where metal actually changes hands, is whatever buyers will pay in yuan or gold. This is not far-fetched. Russia already trades oil in rubles and yuan. China and Saudi Arabia trade in yuan. The dollar's monopoly is breaking. Silver is next. $100 silver is not a prediction. It's a mathematical necessity when you combine a 470 million ounce deficit with China, weaponizing supply with speculative inflows with dollar devaluation. The only question is timing. Does it happen in 3 months, 6 months, 1 year? My guess, based on how fast Monday's crash was bought and how close we are to the January 1st activation, is that we hit $100 by Q2 2026. That's April to June. Maybe sooner if panic accelerates. In part 4, the final chapter, I'm going to give you the strategy. How do you position for $100 silver? What do you buy? What do you avoid? And what are the signs that the move is accelerating versus stalling? The math is clear. The policy is real. The weapon activates in 12 hours. Now you need to know what to do about it. Part 4, the strategy, positioning for the weapon. If you've made it through parts 1, 2, and 3, you now understand the full picture. China activates export licensing in 12 hours. The policy creates a supply shock. The math leads to $100 silver or higher. So now the only question is, what do you do? How do you position yourself to capture this move without getting trapped by the volatility, the premiums, or the misinformation that will flood the market? In this final part, I'm going to give you the playbook for navigating China's silver weapon. First, understand the timeline. The licensing system activates January 1st, but the impact won't be immediate. Chinese refiners will apply for licenses. Some will be approved quickly. Others will be delayed. The market will watch and wait. This gives you a window, maybe 2 weeks, maybe a month. But that window closes fast once the first signs of supply disruption appear. Rule number 1, physical only. I don't care if SLV or PSLV seems more convenient. I don't care if futures give you leverage. If China is weaponizing supply, the last place you want to be is holding paper claims. When industrial users start demanding delivery, when the shorts get squeezed, paper contracts will settle in cash at manipulated prices. Physical metal is the only thing that survives a supply crisis. Buy coins, buy bars, buy from reputable dealers, APMEX, JM Bullion, SD Bullion, check premiums. Right now, premiums are elevated at $6 to $8 over spot. That's high, but not insane. If premiums spike to $15, that's a red flag. It means the physical market is detaching. At that point, you're not buying $76 silver, you're buying $90 silver, but it's still worth it if you believe the thesis. Rule number 2, don't wait for a pullback. Monday's drop to $73 was the pullback. If you missed it, don't wait for another one. The market might not give you another chance. Every day that passes brings us closer to the China impact. Every day, smart money is accumulating. If you wait for $65, you might wait forever. And if silver gaps from $76 to $90 on supply news, you're left behind. Dollar cost average if you're nervous. Buy a third of your position now. Buy another third if it dips. Buy the final third on strength, but get in. Don't sit on the sidelines analyzing while the train leaves the station. Rule number 3, Diversify your storage. If China's policy triggers geopolitical tensions, governments might restrict precious metal movements. They might freeze vaults. They might confiscate bullion under emergency powers. Don't keep everything in one place. Some in your home, some in a private vault. Some offshore if possible. Spread risk across jurisdictions. Rule number 4, set your exits in advance. Decide now what your target is. Is it $100, $120, $150? Write it down. Because when silver hits $90 and you're up 20%, emotions will take over. You'll either panic sell or get greedy. Neither is rational. Have a plan, stick to it. My suggestion, sell 25% at $100. Lock in profits. Let the rest run. If it goes to $150, you captured the move. If it pulls back, you have cash to buy more. Never sell the entire position. Silver in a supply crisis is insurance. You keep some no matter what. Rule number 5, ignore the volatility. Silver will swing $10 in a day. It will drop 15% in a week. The media will call it a bubble. The banks will raise margins again. Your friends will tell you to sell. Ignore them. Volatility is the price you pay for asymmetric returns. If you can't handle it, don't play. But if you can, the reward is generational wealth. Rule number 6, watch the indicators. There are 3 signs that China's weapon is firing. First, premiums explode. If retail premiums hit $20 over spot, the physical market is breaking. Second, dealer inventory vanishes. If APMEX, JM Bullion, and SD Bullion all go sold out on major products, that's a supply shock. Third, COMEX registered silver collapses. If it drops below 15 million ounces, we're approaching a delivery crisis. When you see 2 out of 3, the squeeze is real. Add to your position. Rule number 7, don't leverage, don't use margin, don't buy options. The temptation is strong, but leverage is how you get wiped out in volatile markets. Stack physical, no debt, no counterparty risk, just metal. Now let's talk about what not to do. Don't buy miners, not yet. Mining stocks will lag physical. They always do in the early stages. They have operational risk, political risk, and they're still priced in dollars. Physical outperforms until the mania phase. Once silver is above $100 in mainstream, then you can look at miners for leverage. Don't buy ETFs, SLV, PSLV, they claim to hold metal. But in a crisis, can you redeem? Can you take delivery? For most investors, no. You're trusting a custodian in a system that might collapse. Physical is the only certainty. Don't trade. Don't try to time every move. Buy, hold, ignore the noise. The China weapon doesn't fire once and disappear. It's permanent policy. That means the supply constraint is permanent. The structural repricing takes months, maybe years. You're not day trading this. You're positioning for a decade-level shift. Finally, understand the risks. China might reverse the policy. Unlikely, but possible. The US might negotiate exemptions. Refiners might find workarounds. The supply impact might be smaller than expected. These are real risks, but the asymmetry is compelling. If I'm wrong, silver drops to $65, a 15% loss. If I'm right, silver goes to $100 or higher, a 30 to 50% gain. That's a trade worth taking. China's silver weapon activates in 12 hours. The policy is real. The sources are verified. MarketWatch, Yahoo Finance, Trading Economics all confirm it. $76 silver is not expensive. It's the last price before the weapon fires. Monday's crash to $73 was a bear trap, a flush designed to shake out weak hands before the real move. The smart money bought the dip. The industrial users are locking in supply. The shorts are trapped, and the clock is ticking. In 12 hours, China takes control of 60% of global refined silver supply. They can throttle exports. They can prioritize domestic use. They can weaponize scarcity against the West. This isn't a conspiracy theory. This is verified policy, and the market hasn't priced it in yet. Silver at $76 is a gift, a window, a final opportunity before the supply crisis becomes undeniable. $100 silver is not the top. It's the first target. The structural repricing, the baseline for a world where silver is a strategically controlled resource, not a freely traded commodity. China's weapon activates in 12 hours. Are you positioned? Or are you waiting for confirmation that will never come at these prices? The choice is yours, but the clock is ticking. And when midnight hits in Beijing, the market changes forever.